United Kingdom's financial system.
The United Kingdom financial system is large and has grown rapidly in recent decades by Oliver Burrows and Katie Lowe on June 18, 2015. Importance of financial institution. The financial system is an ever-present feature of most people's lives and a critical part of the economy. Financial institutions are important for the provision of financial services. They facilitate the wage payments companies make to staff and the transaction households make when they are used credit and debit cards to buy goods and services. Provide loans to households and companies to allow some to consumer and invest today, while managing savings for tomorrow on behalf of others and provide insurance against all sorts of adverse outcomes from ships sinking to pits needing medical care. The Bank of England is the central bank of the United Kingdom. Bank of England was established in 1694. This bank has changed from being a private bank that loaned money to the government to being the official central bank of the United Kingdom. The bank started during the period of economic turbulence with the national debt was growing at a steady rate. The Bank of England became the official bank of the UK in 1946. It was owned by the Treasury Solicitor on behalf of the government. Previously, it was the property of stockholders from its foundation. The UK financial structure. The UK financial system experienced significant structural change during the 1970s and 1980s. Before then, the system was segmented. UK financial system provides different kinds of services like commercial banking, invest banking, housing finance, life insurance, fund management, and securities trading. Within the banking sector, there was a clear demarcation between clearing banks, which provide commercial banking facilities and money transmission services largely to domestic customers, investment banks, which provide a range of large market intermediated financial services to both domestic and overseas corporate clients such as equity issuance, and portfolio investment advice, and the building societies which were the main source of the housing finance. Changes to institutional architecture took place progressively over 1970s and 1980s. This was largely an involuntary process, but the number of factors contributed to the intensification of competition and lended to erode the functional distinction between firms. There are 5 particular are worth noting. First, the entry of the foreign banks. This is associated with the continued growth in a euro-dollar market and London's proponent role in this market, prompt the major clearing banks to expand their business into non-traditional markets such as corporate and unsecured lending. Second, the removal of exchange controls in 1979 increased the global nature of competition. Previously, banks' domestic sterling activities were effectively ring-fenced from competition from overseas banks, including those foreign institutions already established in London. Third, in early 1980s, retail banks entered the domestic mortgage market, a market that had previously been dominated by the building societies. This increased competition led to the abandon of the lending cartel and mortgage that had restricted prices and encouraged quantity rationing in the provision of housing finance. Fourth, during the 1980s in particular, the financial system became more market-oriented. Banks faced growing competition from other providers of savings, media, and credit financing for households, as well as competition from capital markets for the provision of external finance to firms. And lastly, the regulation in the UK securities market in 1986, so-called Big Bang, to remove restrictive practices in security trading tended to bring traditional banking system and the securities industry closer together, and the functions performed by institutions have increasingly been merged. And that this reform encouraged a number of the large UK and overseas retail banks to build a presence in the securities market in London through acquiring existing securities houses, investment banks.
Development and practices of financial system. In the development and practices of financial system, the development of the financial sector is about overcoming the costs incurred with the financial system. This process of reducing the cost of gathering information, fulfilling contracts and conducting transactions has led to the emergence of financial contracts, markets, and intermediates. Financial sectors is the regulatory framework that enables transactions through a range of institutions, instruments, and markets. The five key functions of financial systems are prepare advanced information on potential investments and capital allocation, exercise cost, fund the investment of oversight and corporate governance, facilitate trading diversification and risk management, and mobilizing pooling savings. Functions of financial system. Having a well-functional financial system that directs funds to their most productive uses is key to recruitment for economic development. The financial system consists of all financial endeavors and financial markets, as well as the flow of money between households, governments, business, and foreigners, and also the relationship with financial structures.
Elements. There are five key functions of a financial system. 1 are producing information, activity about possible investment and allocate capital. Number 2, monitoring investment and exerting corporate governance and providing finance. Number 3, facilitating at trading, diversification, and management of risk. Number 4, mobilizing and pooling savings. And number 5, easing the exchange of goods and service. Nature. Financial system promote the overall domestic and international economic, the financial stability. They provide the framework for allowing economic transaction and implementing monetary policies. These policies help properly facilitating investment and exchange, channeling savings into investment to support growth. Systems also ensure monetary policies are effective to help manage and root risk and prevent a range of problems such as economic downturn or increasing fiscal costs. This is increasingly important with the growth of the fintech companies and increased connectivity and financial and trade. Link between different countries' financial system help prevent issues through policies that apply for multiple sector and borders.
Monetary policy of United Kingdom affects how much prices are rising. It's called the rate of inflation. We set monetary policy to achieve the governance target of keeping inflation at 2%. Low and stable inflation is good for the UK's economy and it is our main monetary policy. The monetary policy that used in UK is that since 1992, British monetary policy had been guided by the inflation target, which has been set at 2% since 2003. And the average rate of inflation since the end of 2000, just before the crisis, has been 2.2%. So that monetary policy has been pretty successful in achieving its main objective. The UK have independent monetary policy. Since we were granted operational independence over monetary policy on May 6, 1997, our responsibilities have grown to include financial stability and regulating firms such as bank and insurers, the international organization, the United Kingdom, and the international organization. So their Commonwealth is an association of countries that support each other and work together toward shared goals and democracy and development. Most member states were once part of the British Empire, although a few countries which were not have also joined. So their queen is the ceremonial head of the Commonwealth, which currently has 54 member states. Membership is voluntary. The Commonwealth has no power over its member, although it can be suspend membership. The Commonwealth is based on the core values of democracy, good government, and the rule of law. That's all. Thank you.